Hey there, everyone. I usually say happy Monday. I don't know how happy of a Monday it was for some of us, but welcome to Chart This with Dave Keller. I'm your host, Dave Keller. It's Monday, March 10th, coming to you from an overcast Redmond, Washington. Excuse me. So thankful to be back home in the Seattle area. Great visit to New York and to Baltimore. Pleasure to be back with you here. Awesome to see my family again, reconnect with this area of the country and with people that I loved and missed. And a pleasure certainly to be with you here as we try to make sense of what we observed through the course of the trading day today. Hopefully, if you've been a long time viewer of the program and you followed my work, days like this should not be a huge surprise given the proliferation of concerning evidence that we've been sort of surfacing. And again, the problem with a market that is in a primary down phase is that days like this can happen, and they're painful when they do so. Especially coming after a 2024 where we had so many very viable dips on the way up. We've in the last couple of weeks covered how the deterioration has accelerated from the leadership rotation, the breadth of momentum divergences, the breaking of the line in the sand last week, which we cited as a key thing. Our medium-term market trend model finally turning bearish as of last Friday. So all the sort of things are lining up that this is something different. None of those things that we just described happened in those tradable pullbacks in 2024. The problem, I think, for a lot of investors is you get to the point where you treat every pullback as a very viable one, and I don't blame you because that tends to work, and every time that works, it reinforces it. But that's why I find charts and technical analysis so valuable, is because they help you recognize when something's different, what we call a change of character. And again, I hope you've been following as we've been sharing some of the evidence here. And I certainly hope you continue to follow along as we attempt to navigate these markets the best we can. What we're going to do today is try to make sense of today's drop. And again, for the NASDAQ, biggest drop since 2022 with about a 4% loss for the NASDAQ 100. At Tesla having its worst day in probably 3 to 5 years, I would guess. It's been pretty rough. So enough of an intro. Let's look at what actually happened. Then we'll talk about the charts and what this day means within the pullback phase that we've been talking about, this corrective move. And then we'll focus on some individual stocks on the move. There's way too many individual stocks to track relative to the amount of time that we have, but we'll try to grab a couple. And then at the end, as always, we'll try to take a question or two. And I appreciate those of you tuning in live on Facebook, LinkedIn, YouTube, and X. I really appreciate you doing so. Please ask questions as we go. We had a great mailbag episode on Friday, by the way. I usually in this sort of environment, I tend to get more than average number of questions, and I appreciate you doing so. That'll give us things to talk about on the show today, but also anything we don't get to, we'll put it in the mailbag. This Friday, we're planning another all mailbag episode, and we'd love to answer one of your questions in that discussion. All right. The S&P 500 closing just below 56.15. We're at 56.1450 or so. That's down almost 3% from Friday's close. The NASDAQ composite, as I mentioned, worst down day since 2022, down 4% today, just below 17,470. Mid caps, small caps, all down as well. Large underperformed small today. The Dow, which was the best of the major U.S. indexes, still down over 2%. The VIX moving about 4.5 VIX points higher. We're now in the upper 20s. We briefly actually pushed above 29, which, going back to an interview I did years ago with Tim Hayes of Ned Davis Research, he talked about that being the level that in their analysis spikes above 29 means forward returns are much lower than average, right? And so, again, I've run out of signals. I mean, I continue to share things that tell you this is part of a bigger corrective type of environment from the Hindenburg Omen back in December to where we're at today. So the VIX continuing to accelerate, higher volatility, wider spreads. It's all kind of playing out as you'd expect as we see this rotation. We'll look at the chart of the S&P 500. Our objective is 5,500. That was an objective, as I'll show you in the chart review portion, based on the framework from the August to December rally. We start breaking that. What you do is, when in doubt, zoom out. You take in a longer-term time frame. You chart to find some longer-term Fibonacci objectives. You look for longer-term support levels. Short-term pullbacks, you use short-term data to make the objectives. when all of a sudden it feels like a bigger thing, then you got to zoom out more and bring in more data and think more about longer term levels. So, we'll see what happens between now. I mean, we got halfway down to 5,500 today. So we're not that far away all of a sudden, less than 100 points. All right, bond markets. The bonds actually moved higher today. The TLT was up about 1%. Interest rates generally moving down. The 10-year is just above 4.2%. The long bond yield right above 4.5%. 5-year point just dipped below 4%. So we're seeing bonds continue to strengthen in the face of equity weakness. That was not the case in 2024. You kind of had stocks and bonds moving together for much of that year. 2025 getting back to more of a traditional, I guess, inverse relationship between stocks and bonds, where when stocks tend to move lower, bonds tend to be kind of a safe haven. So, where are you seeing flows? What are things that are actually going up at a time when then the S&P and the NASDAQ are going down? Two things immediately come to mind: bonds, number one. Maybe three things: bonds, number two, precious metals, and sort of that area of commodities. Although today they were down, but generally still fairly strong. And then defensive sectors like utilities, which was actually up today. Looking at the commodity markets, you can see a lot of red here as well, but not as bad. Gold was down about 0.9% using the the GLD. The SLV, the silver ETF, down about 1.6%. Crude oil prices lower, although energy actually did pretty well. Some of the big energy names like Exxon, Chevron actually moving higher today. As we look at the heat map, you'll see a lot of red, but little pockets of green. I would encourage you to focus on the things that are actually up at a time when the market is doing this sort of thing. Cryptocurrencies, not great. Cryptocurrencies very much, acting like a leveraged risk asset. And what I mean by that is a risk asset would be, think of bonds, right? Buying like a 10-year treasury bond is kind of a risk-free bet, right? You're basically betting on the fact that the U.S. government is going to be able to meet their debt obligation. Granted, nothing is a guarantee in this current environment. Year to date, I get that, but compared to other things, as risk-free as you're going to get, besides just putting money underneath your mattress, buying U.S. Treasury bond is still a pretty safe investment and fairly stable. And so it's considered kind of a risk-free or very, very low-risk thing. So everything else, right? There's a thing called the equity risk premium, which is if you buy a stock, you're taking on additional risk because an equity is riskier. Companies can have problems and all those sorts of things, but you have the opportunity for a greater return, right? So with a risk-free investment, you're not going to make a ton with the treasury bond, but it's stable and you're going to make something. Something like an equity, you stand to make way more, but you also stand to lose way more. So you're accepting additional risk for additional return. So a risk asset would be anything where you're taking on risk for potential return. So equities, commodities, currencies probably different. Equities, commodities, ETFs, cryptocurrencies. So when I'm saying it's a leveraged risk asset, it's kind of like a risk asset that's way more volatile than the market. So when the markets are up, cryptocurrencies have tended to be up way more. And when the markets are down, we're seeing that cryptocurrencies tend to be down a lot more. Now, that was unknown. That was sort of an unknown. And I remember as we were just sort of cryptocurrencies becoming more popular to the point that, in my, when I'm at stock charts, we actually added the crypto market overview because it's like, all right, this is big enough that people now want to know where Bitcoin and Ethereum are. All right, we better put it on the front page. But from, at that point, there really hadn't been a big bear market to know what are cryptocurrencies going to do when equities and ETFs really start to sell off. And I think what you're seeing in 2025 is they're moving down a lot more than equities, right? They're losing significant. Now Bitcoin today down less than the S&P. That's fair, but off of its recent high, it's had much more of a decline from 108,000 to 79,000 than the S&P's decline so far. So cryptocurrency is really not kind of a safe haven. Although at one point I remember it being speculated that maybe they would be. They are not. I think they're a leverage kind of speculative investment. They've had really good stretches of outperformance. The history of Bitcoin in particular is filled with big, significant 50%ish drawdowns. And I'm not going to say that that's a likely scenario here, but certainly if you're concerned about equities going to like a safe haven of Bitcoin, that's not happening. I don't think, or at least the evidence would not support that as a reasonable thing to do with your capital. All right, looking at the sectors, and again, this is where I want to remind you, right, that not everything is going down, and even in the most bearish of bear markets that I've weathered in the last 25-ish years of doing this, something somewhere is always up, and that is one of the fascinating parts of investing. Fascinating parts of looking at equities in particular is that something is going to work, right, in different environments, because there are a lot of company specific different thematic issues that are kind of immune to market forces sometimes. Today, utilities were up 1.1%. Energy was up 2/3%. It's good. Staples down slightly, down less than 1/4%. Big gap down to your FANG sectors: technology, consumer discretionary, communication services, down 2.5 to 4.5% today. So it's the growth trade continuing to not work. I mean, hopefully you've been following, as we've talked about, the rotation away from growth into other things. I remember at the end of 2024, I had a lot of growth things in my portfolio. I have very few growth things at this particular moment. I mean, I still own the ARK Innovation Fund. Not feeling great about it. It's down about 9+% today, but it's a small percentage where growth used to be the bet I was making. As I've seen these concerning signs, I've rotated to more things like defensive value-oriented sectors because the charts just look better. And I think that's what you need to remember in this environment. As a technical analyst, as a trend follower, you don't necessarily need to understand, although I'd love for you to understand why utilities make sense here. If you can just follow the trends and recognize what's working, recognize when people are selling out of these magnificent seven stocks, like what's working, where are they rotating to? That's the question I think you want to be trying to answer. At least that's where I find charts can be so valuable. I mean, I think you've followed it. I'm assuming by the fact that you're watching my show that you've at least seen that things were pretty rough today. But just to put some specifics on it, the breadth was very bad, and the breadth has been more and more concerning in recent weeks. But last week we had a couple big down days. Today, another one. The New York Composite Index, the Nasdaq Composite Index, about a 4-to-1 ratio of decliners versus advancers. You had about 80% down versus 20% up. It is interesting that the S&P 500, the best, still bad, about 2-to-1 ratio of stocks down versus stocks up, but better than these other indexes. So the breadth in the S&P was the least bad, but they were all pretty rough. Our market trend model on Friday, we did have a brief market recap before we got to the mailbag on Friday, just because things had been so fluid last week, and we talked about how our medium-term market trend model looked pretty likely to turn bearish, which indeed it did. That's the first sell signal we've had, or first bearish signal from the medium-term trend model on the S&P 500, which is the main one that I follow. First one since kind of fall of 2023, which is when sort of that July, August, September pullback. The medium-term model went negative for about 3 months, 2 to 3 months, turned back positive in November of that year. Remained bullish all through last year, remained bullish up until last Friday. So the short-term model has turned negative a number of times here in the last 18 months. This is the first bearish signal we've had from the S&P medium term, which for me is a big deal. That is how I really think about risk on versus risk off. The fact that we're now bearish tells me I should be focusing primarily on capital preservation, not on capital growth. My goal should be avoiding the bad stuff more than I want to be participating in the good stuff. Don't get me wrong, though. Things that are going up, I'm probably going to want to be there because that is how you outperform in a down market. But that is the general mindset I'm in. All right, here's the Magnificent Seven and friends, and I feel like air quotes need to be liberally applied when you use that phrase anymore, given how less than magnificent these have appeared. The best performers out of this group of mega cap growth stocks was Amazon, still down 2.4%. Netflix down 2.7%. Microsoft down 3.33%. Tesla, the big underperformer, down another 15%. I haven't showed the chart of Tesla on the show probably in a week or two. I can show it to you if you want. It's just going down a lot, and so I feel like that message was portrayed. It was conveyed. You got it. I don't know how much we need to reinforce it. It's going down. It's not a good chart, and really one of the, I mean, by far, I think the worst of this basket. But even Nvidia, Apple, sort of the big technology names, along with Microsoft, both down about 5% today. So, very much this was a risk-off day among risk-off days. And as we get to the chart portion, we'll talk about the S&P breaking its 200-day. I mean, if there's anything to hold on to, and I remember on Friday, it was like what is not horrible that we can kind of hold on to? Like maybe this is going to work. The 200-day holding for the S&P, that was like one of those things. Like, well, as long as we can hold the 200-day. But today, sort of with an exclamation point, breaking that to the downside. All right. As we go to the market carpet again, I do see some great questions coming in. I appreciate it so much. Please keep them coming wherever you're watching. If you're watching it live, I'll grab as many as I can before we finish today, and I'll happily put some of these into the market misbehavior mailbag, if we could, or the chart this mailbag, we should call it. All right. Here's the heat map, and you'll notice some concentration of bright red, right? And we have to start there. I mean, big down day, of course. But look at how these mega cap growth names, generally speaking, were down a lot more than the benchmark, right? So the market was dragged down, driven by these growth stocks. However, there were plenty of things that were actually up. And that's the second thing we'll talk about is look at all the green on here. Now, granted, not a ton, but it's a decent amount. I mean, back in like financial crisis days, like 2009-ish, this would look all red and bright red to kind of red, right? I mean, it was just these ugly, horrible, literally everything down where everyone's just selling all equities and moving to something else. Certain areas of the market actually had a pretty decent day today. Exchanges in the financial sector, energy, I mean, big integrateds, utility companies, healthcare stocks, some biotech, some pharma, services, consumer staples, right? Tobacco stocks making new 52-week highs today. So it's not like there aren't stocks that are working. And again, I think there are some times where it's not hard to find names that are moving higher. There's sometimes where you have to put in a little bit of effort. And I think this is one of those, but it's not that difficult. It's not as hard as you think when you increase your perspective outside of mega cap growth, which is unfortunately we've had the blinders on in that area of the market for quite some time. So in the technology sector, except for like end phase, which again is probably one of the uglier charts I could cite for you in the technology sector in a consistent downtrend for the last 12 months or so. Besides that, pretty much everything else down, and they were down quite a bit. And if you've been waiting, if you've been holding on to, well, at least technology is not breaking down too much. I don't know if that's intellectually honest to say that at this particular point, given the follow through that we've seen today, right? I mean, this just reinforces the fact that we're not in a bull phase, by my perspective, that this pullback is not just a brief pullback. It's probably something more significant. And even if it's not, I'm way more comfortable at this particular moment getting more defensive. Like I have no problem being defensive in this environment because there is an elevated likelihood that it gets a lot worse. And I'm okay with it being a little worse and maybe me missing out on a little bit of the next recovery for the benefit, for the peace of mind of not participating in a 10, 20, 30% further decline from what we've seen already. And that's possible. So when technology does this, when they continue to break down, I'm not seeing exhaustion here. I'm seeing, early day. I mean, things are just breaking their 200-day moving average today. So I feel like it could still be earlier days. Elsewhere, obviously, the big, the three big growth sectors: technology, consumer discretionary. Of course, Tesla is the big down day, but Amazon down over 2%. I mean, Starbucks, which had actually made a new 52-week high last week, new all-time high last week, giving back a lot of those gains, down about 10 to 15% off of that high, down another 5% today. In communication services, Meta, Alphabet, just clearly changing character from late January to now mid-March. They are very different charts, right? Back in early February, it's like Alphabet just making a new all-time high, Meta in this resilient, strong uptrend. But what's happened since then is both of those have just completely reversed. So again, things have really changed from mid-February now to mid-March, I think, undeniably so. In terms of other red, I mean, the other big pocket I would tell you would be the big box retailers. Costco had earnings last week, didn't go great. And so Walmart, Costco continuing to pull back. And those had been some of the stronger charts sort of in that previous cycle, right? As growth stocks were working, it was like a bunch of growth stocks and Walmart and Costco, big box retailers, tobacco companies were doing pretty well during that period. But now it's kind of the other stuff: food products, cleaning products, those sorts of things, household goods, beverages. These are things that are starting to, improve, right? So you have like Brown-Forman today bouncing and continuing to rally off of a 52-week low that it hit just a week or two ago. So in this environment, what do we do? Well, besides just, lamenting on the fact that there's a lot of things down today, I think a day like this provides a fantastic opportunity to focus on what's actually working. I did a video. I do a weekly show on Stock Charts TV still. And I did a video earlier. I'm not sure if it's posted yet, but I sent it over to the team there earlier today, looking at 5 stocks. I'll show you one of them here as we get to the chart review. But 5 charts, and they're all pretty much in the green today, right? These are names that are actually doing okay. And so in a day when everything's down, where it feels like everything's down because the big names are all down, your portfolio might be down quite a bit, depending on what you own. Focus on things that are actually in the green, because these are things that are doing what the market is not. They're actually finding strength, and in some cases, finding renewed strength. Right, it had been in uptrends, but are continuing higher. And I would say things like CME, like market access. No, that's a bad idea. CME, SIBO. I'm thinking of the exchanges. These are ones that have actually been pretty decent charts here in 2025 and are just continuing, right? They're just not pulling back while other things are. So these are charts that are in more consistent uptrends. Some of the pharmaceutical names may be on that list. Some of the auto parts companies, right? Like AutoZone, has been in an uptrend for 6 months. So these are names that are continuing to be strong, even though the market averages are not. Then you have others, which are a lot of staples that have actually been pretty rough charts, like a Brown-Forman is a good example, a stock that has been going down for quite some time, and now it's starting to change. And so what you're seeing is a general rotation from growthy previous leadership names to the new leadership, the emerging leadership names. And where we're seeing green today are some of those emerging areas, right? Like utilities, consumer staples, energy, although crude oil prices, I still think, make energy not a great general bet. They're bouncing today while other things are not. And then in healthcare, right? I mean, you're seeing a lot of names in the healthcare space that are, like McKesson making a new 52-week high and just really continuing to break out. All right, we're going to continue on here. I did say someone mentioned in the chat, and I appreciate you so much, Richard, pointing out. I will be speaking at the CMT Association West Coast Regional Summit. That is true. August 4th. And my birthday is August 3rd. So we can consider it a CMT market discussion and Dave birthday celebration. I think I've already told Tyler at the CMT, I'd expect at least some recognition of the birthday. So we'll see what we can score there. However, it will be a really fun event. The CMT Association, survived and thrived through the COVID era. And I'm so thankful that nonprofits like the CMT Association were able to do so. I think in based in no small part of the efforts of the board and the team there, like Tyler Wood and others, to keep that organization growing. And I'm so thankful that they did. And I would say chapters on the West Coast have struggled to kind of get things back going. I know in the Seattle area, we have a chapter which is now dormant. Boy, I would love to see some of the West Coast operations kick off again. I think that's part of the effort here, is to get a bunch of people from the region. And certainly you're welcome from anywhere to head to San Francisco and go to the event. It's going to be a lot of fun. And I'm told on the Sunday, it's an event on Friday evening, all day Saturday. And then Sunday, I think there's a Sonoma wine country tour as well that's going to be part of it. So it should be a lot of fun. And I would hope to see some of you there for sure. You can find more information at cmtassociation.org. But I would love to meet any of you that are going to attend. Hope you can say hello. All right, looking at the daily chart of the S&P 500, I just want to highlight today, on an intraday basis, we are now about 9.5% off of the high from a couple weeks ago. That's from third week in February to where we're at now, second week in March. What that means is that this pullback we've just experienced is almost identical in time and in distance, right? Time and price to the July to August 2024 pullback. So if this is, and now we've far surpassed some of these 3 to 5% pullbacks, kind of the garden variety pullbacks we had through 2024. So this is already at least a little more significant, but we're just under 10. And that's where this one stalled out in early August. And we gapped lower into the low day there the first week in August. And then we just started to trade higher, right? We started making higher lows. And I think that higher low in September was one of the signals that, okay, maybe this is a nice recovery. The break back to a new high is, I think, the only thing that really gives you the all clear sign and tells you we're probably going to move a lot higher from there. So I think it took a little bit of while. I mean, from early August, the actual bottom to the higher low, that was about a month. To the eventual breakout, that was about 6 weeks after the low. And so, again, while we think of bottoms as like a moment, they're often more of a process, and there can be some false starts and hiccups along the way. Now, back here, we never got below the 200-day moving average. We've already done that. Back here, we actually held support. That's why I left this red line here, was just show that we actually never broke below that recent swing low. We've already done that. So while in time and depth were about the same. I would say the technical configuration already feels different to me. The other thing would be the strength, right? So we had a very strong market. We're overbought here, and then we kind of make the low. Here we've actually been stalling out for quite some time. So we've actually, our last major high was back here in early December. Then we've had a couple like false breakouts before the breakdown. The momentum has actually been more bearish than bullish for a couple months now. So again, it already feels very different, and the leadership is very different, of course, from where we were then and there. But again, in terms of an actual price pullback, it's about the same. Again, my expectation is clear from the fact that my objectives are below where we're at. Is that we continue lower. I think this could be just the beginning of something worse. I'd love to be wrong. And don't, when I tell you I think the market's going lower, please don't assume that I feel any joy about telling you that. I'm just looking at the evidence and I'm telling you what I'm seeing. That's what I was trained to do as a CMT charter holder. We highlighted on Friday's show and over the weekend with my market misbehavior premium members, we dug into this a lot more. My market trend model, I think more than anything, has helped me to remain engaged in the market during viable pullbacks, and it's helped me get out of the market and get out of the way when I think things are getting, or when the evidence is telling me that the picture is changing more to the negative side. And the medium-term model turning bearish on Friday's close for me is just another big check mark in the uh-oh list, which is things that would tell me this is probably the beginning of something worse. The medium-term trend model turning bearish. The last time it turned bearish was in September of 2023 during this 3-month pullback phase. We're still pretty early on in that. I mean, by my measurement. So we'll see. But for now, the medium-term trend model definitely turned bearish on Friday. The newer Dow theory, boy, I have alerts set up for pretty much everything. I feel like every trading day in the last week, my phone and my stock charts login have lit up with alerts that I set that have been triggered. Today, it was the equal-weighted NASDAQ 100 briefly going below and actually closing below the January low. I'm pretty sure the RSP did intraday, but I may be wrong on that. But I think I saw an alert along those lines. I might be making it up. I was looking at a lot of things. But for now, at the close, that means we have one of these two indexes making a new low and the other one not quite. If the equal-weighted S&P breaks just a point or two lower, that would complete what I call a Dow theory sell signal using a modernized version of Charles Dow's original work. This is more of a lagging indicator, right? The Hindenburg moment is more of a leading indicator. It tells you we're still going up, but it's looking more like a top than like the middle inning. It looks more like the 9th inning than the 3rd inning kind of signal. This is more, we're now in a confirmed downtrend. It's more of a lagging indicator that confirms that price is actually deteriorated. So the leading indicators in my work have all fired November, December, January. These are now the lagging indicators telling you, yeah, that thing was the top and now it's a valid downtrend. So very, very close. This is something we'll be watching closely this week on the program here. The percent of stocks above their key moving averages is getting worse. And I would say this one in particular is a concern for me. Other things that I mentioned that I'm watching in this week would be whether this indicator can hold 50%. It appears today it is not able to do that. We're down to 47% of S&P stocks above their 200-day moving average. Now, that's not horrible. I mean, that means almost half of the S&P names are still above their 200-day. But just like the S&P and the NASDAQ have broken their 200-day moving average, this looks at all 500 or so members of the S&P and says, are they holding their 200-day? And now most of them aren't. And that's a problem, right? So in late September, we're at like 82%. At the end of last year, we're around 55%. On this, most recent attempts to new highs, we're in the 65% range. Now we're down below 50%. So more and more stocks are unable to regain the 200-day moving average. Most of them are breaking below, and that's a sign of a distribution phase. We'll skip that one. We talked about that one on Friday or on Thursday. I don't need to get any more into that. The VIX did briefly today break above 28.50. It got up to 29 and change. By the close, it was back down just below 28, but volatility is certainly elevated. We are now at the same general levels we got to in December during that brief pullback, in July, August of last year during that pullback. And we're certainly sort of getting to a very new volatility regime, right? A much higher volatility environment. I mean, the market certainly feels more volatile. The headline risk seems very volatile, which is all true. I would say with this, in this case, we're very, very close to a panic button kind of thing. An interview I did years ago with Tim Hayes of Ned Davis Research. If you're not familiar with Ned Davis Research, they have a wide and very devoted following in the institutional community. When I worked at a big money manager, we all got Ned Davis Research. I was able to meet with Ned and have dinner with him and ask him questions about market history, which was really, really fun. And their team are all just really thoughtful, knowledgeable market practitioners. And they have an incredible database. So they were really good about saying, all right, when this happens with the VIX, these are your average 3-month returns, 6-month returns, 12-month returns. When the VIX is in this range, here's your average return. When the VIX is down in this range, here's your average return. And generally, the lower the VIX, the better the forward-looking returns are. And the VIX over 28.50, over 29-ish, somewhere in there is where they found in their work, that is like the panic button. When that happens, your forward returns for stocks are actually much lower. And I think they're actually, I forget the averages. I'll have to go back to that interview. I'll see if I can dig it up. It was on Stock Charts TV a couple years ago. But if you look for Dave Keller on Stock Charts TV with Tim Hayes of Ned Davis, you'll find the interview from, we'll call it maybe 2 years ago, I'm guessing maybe or so. But you can see what he said about that level. We're pretty close to triggering it yet again. I'm going to make a note. Maybe I could get him to come on the Old Market Misbehavior podcast. Let's see. All right. Bitcoin, as we mentioned in the market recap, I don't want to belabor it too much, but Bitcoin like a leveraged equity play at this point. And so breaking down through the 200-day, just like the S&P, our downside target on the Bitcoin was around 74,000. That's a 61.8% retracement. What's interesting is with today, it feels like we're getting very close to that downside objective. We're also getting very close to the S&P 5,500 objective. We start breaking those, you need a new objective. So, and I don't have one. So we'll see what happens if and when we hit those levels. But that's where I'd anticipate at least some sort of tradable bounce would be my thought. All right, looking at some individual stocks, and we'll take some questions or two. Let's see, Amazon breaking below the 50 or the 200-day moving average. When the market moves down like this, what you usually have, and for understandable reasons, we start to look for like a line in the sand, like what would be the saving grade? What would be the signal that would tell us, okay, as long as XYZ holds, it's okay. And I was chatting with Grayson Rose last week about Amazon testing the 200-day moving average. And I remember on this day, it's like, ooh, is this a bounce? And this is just going to be the recovery. Maybe that's the pullback, and then we recover. Friday, we kind of traded right to it, and then today we open and close below it. So the 200-day moving average is holding less and less. This is why that breadth indicator, the percent of stocks above their 200-day is breaking down, because charts like Amazon were holding it and now are not. And so the more stocks that fail to hold the 200-day, the less this feels like a buyable dip for now, and it feels more like the beginning of a further deterioration. NVIDIA and other technology names, particularly semiconductors, looking quite weak here. We talked about the gap lower, the bounce back up into this range, but look at, take a step back and think about what this means, that we broke below support. We bounce off of the 200-day to get back in this range, but then it doesn't hold. And this day, which is about almost 2 weeks ago, was a big one where we just violated the 200-day and then couldn't regain it. We haven't even touched it. We've made, lower lows pretty much every week since that moment. So I would say, for me, NVIDIA and other semiconductor stocks essentially in a clear downtrend phase, right? Making lower lows and lower highs, that's a downtrend. And so until that changes, it's hard for me to be optimistic about an NVIDIA. That would be a wishful thinking trade, if anything. CrowdStrike, another example. I don't want to bring up every technology name I can come up with, but this is what's happening in the growth sectors. This is why those sectors were down so much today, because this is what the technical configuration looks like. If you draw trend lines off of these lows, they've all been broken. We could draw trend lines off of those highs, which is what I like to do in a downtrend phase. So just to digress a little bit, if you're concerned about a CrowdStrike, or you're thinking like, when do I get back into a CrowdStrike or something like that? I mean, not a perfect, approach, but I mean, one basic thing to do is draw a trend line off the highs, right? So just kind of take these swing highs and just draw the trend line and save it, right? And as long as we remain below that trend line, things are not getting good enough by my read to really, for really a real significant recovery, right? Until we break that trend line, we're by definition in a bit of a downtrend. I think that's the way to think about some of these names. All right. Sorry, I jumped a couple charts ahead. Here we go back to the list. Got a couple more charts. Delta Airlines in the news today. They lowered guidance for the year. I just flew, again, I flew Alaska and took an Amtrak, so I did not fly Delta, but Alaska is the biggest carrier out of SeaTac here. And flying around, obviously it's been a crazy stretch here with, while there's still so many flights that take off and land with no issue, there have been a number of concerning airplane developments here recently. 100% true. And Delta basically lowered guidance. It's less about safety necessarily, although they were basically saying, demand on like international routes and business class. Airlines tend to make money by people paying full price for expensive tickets, and that demand is struggling as companies lower and sort of reduce their own spending. That will hit airlines, and so especially domestic flights. It looked like Delta was lowering their guidance as a result of that. So down another 5.5%. We're down quite a bit from a high of 70 to now where we closed just around $50 a share. That's a big haircut in about 4 to 5 weeks. And so again, this is the danger in this environment. And as we get into the next earnings season, which is only about a month away, right? Second week in April, you start to get the next earnings season. That's where I think we'll start to see maybe some additional downgrades of expectations. And hopefully not, but that's where you could see another big wave of concerning headlines. This week, by the way, inflation data is going to be the big thing, not as much earnings necessarily. Some things like Costco are still holding up, and I think in general, right, names that are holding their moving averages are doing better than ones that are not. However, Costco very, very close to lines in the sand, and the reason why I wanted to show this chart was, what I'm often asked, like, what do you do? Like, if you're really concerned, you just start selling everything. And again, not a recommendation, but in my opinion, charts that are still working, I would never sell a chart that is looking good just because I think the markets are going to go down. Like if something's going up when the markets are going down, those are the kind of things you definitely want to still own, because that's how you outperform in a down market. That is the secret of most active money managers, which tend to outperform in down markets. It's because if you can find things that are holding up or not going down as much, or ideally going up a little bit, even a little bit, while the major benchmarks are getting crushed, that's how you outperform beautifully in a down tape. So, a Costco is okay, I think, as long as it holds the 200 days, as long as it holds that swing low, which means 900 is kind of the level. So if it breaks 900, I think you'd struggle to have a technical justification given the fact that we're now making lower lows. But until then, maybe, again, with a longer term time frame, maybe it's okay. And so I think, thinking of your stop losses and having a stop loss discipline for individual positions is so important. Couple more charts here too. We'll finish with a note of optimism. As we saw from the market carpet, there are things that are going up. My interview with Jay Woods, and I interviewed him last week for the Market Misbehavior podcast, 2 weeks ago, that is. Please check that one out. And I also just posted last week 3 interviews from the Las Vegas Money Show, which were really, really interesting. But my conversation with Jay Woods, we talked particularly about exchanges. We talked about the financial sector in terms of highlighting areas of the market that were so strong. CME made a new all-time high today, right? While the markets are going down, charts like this are actually breaking out. This is not the only one. This is one of the 5 stocks I mentioned on my Stock Charts TV show earlier today. Check that out for the other 4. But I think charts like this, I would not personally, if I own CME, which I don't, if I owned it in a portfolio, I would not sell it because I'm worried about the markets. I would want to own this. I'd probably, would want to own as much as possible because it's going up while other things are not going up. Tractor Supply Company. This is one of those things. This is why I would tell you candle charts are still pretty important. I looked at the candle chart of Tractor Supply Company just to show from that initial sell-off from the October high around 61 to the October swing low just below 53. You can see we traded right up to the 61.8% retracement level. We then bounced off of the 0 level, that support level, a number of times. We often traded up. And look at these long upper shadows, these long upper kind of wicks of the candles there in January. Here in February, we just traded up there and pulled back. Today, we opened down here, traded all the way up to almost 60 before closing back below resistance. So that's called a shooting star candle. So just the next 1 to 3 bars are probably down rather than up. But overall, watch for candles like this in charts that are going up. This kind of candle suggests an evaporation of demand and more likely a reversion lower. So in uptrends like this, in a concerning market tape, I do tend to pay a little more attention to candle charts. All right, let's see here. A person, love your handle. This is one of my favorite quotes about flying, and I will tell you, as a student pilot, we threw this around all the time, and my instructor first told me this. Greg Morris, one of my mentors as an investor and as a pilot, shared me this quote: "It's always better to be on the ground wishing you're in the air than in the air wishing you're on the ground." And they use that phrase to describe how, again, you want to be managing risk effectively, and being up in the air, not in a bad situation, is not where you ever want to be, right? You never want to be flying into bad weather, into unsafe conditions, into all of those things, into uncertain volatility. You want to bet on certainty. That's why I use checklisting, would be very, very systematic. So that was a way of reminding you, like, if the conditions don't look good enough, like, don't go. And what happens is, a lot of bad airplane things, particularly with private pilots, there were signals that you should not take the plane up, but people do anyways because they feel like they'll just figure it out, or it'll be okay and they'll make it work. And you usually don't want to do that. So that's what I always tell you when you're looking at the weather, looking at the winds, looking at the conditions, looking for lightning, looking for cloud formations that would tell you maybe things are turning poor. It's like, listen, if you're not 100% sure that it's going to be safe to get from where you're at to where you want to be, don't press it. And it's better to be late and alive and safe than trying to get there early and having it end poorly. So thanks for sharing that quote. It's one of my favorite quotes about investing. I have about flying that I think is very relevant to investing. And so how does that relate to investing? It's like, if you're not sure, being in cash and just being out of the market and being safe is better than having money at risk where you potentially can go down quite a bit. 3P Investor, thanks for watching. As always, you said the Hindenburg omen and the lag period before the onset of correction has come true. I appreciate you saying that. I mean, I think signs like the Hindenburg omen are early warnings. And what's so funny, having had made noise about that one before, I've learned anytime I mention the Hindenburg omen, people immediately make fun of it because the market's usually going up at that point. And so you seem like a total idiot when you start dropping Hindenburg omen. It's like, the market's going up. What are you talking about? But again, that's what's so beautiful about leading indicators like that. They don't always play out. But again, I've learned to pay attention to them and recognize when there's a possibility. So thanks for mentioning that. How long after the post-Hindenburg correction one can expect recovery? Yeah, so there are a couple things you can do, right? If you're looking at the markets and you're thinking like, how long does this take, and all that. So what I was doing when I showed my, which one was it? It was this one, the daily chart of the S&P. When I sort of show this, the only thing you can do when you have a downtrend like this in my toolkit is just go full trend following mode and use the tools that we talk about. Look at the trajectory of the moves, look at breadth indicators, and look for signs that things are starting to improve. Look for signs of accumulation, right? We always talk about at some point, right? The market's not going to go to zero. And the history of the equity market is filled with corrective moves that are fully recovered, right? The market has fully recovered from every pullback in history, right? And that's, that because we've made new all-time highs just a couple weeks ago, right? So we always come back from corrections, right? Knock on wood. I'm assuming that's going to play out for longer than you and I are trying to play this game or live. So what you can do is basically look for that sign of accumulation. I have a market bottom checklist, which I'm not ready to dig out yet, but I'll probably start digging out at some point. If it gets a lot worse, then you have to say, okay, we're now in a downtrend. What would I look for signs of accumulation? And, signs that we make higher lows, signs that the volume starts to improve, signs that, lagging indicators like MACD and PPO start to trade higher, bullish momentum divergences. Those are the kind of the things that tell you maybe we're bottoming. I'm not really seeing any of those things yet necessarily. I still see like early stage decline kind of signals. So that's one area of thinking. The other thing is just look at how often do we pull back? How long does it take? How deep does it tend to be? But the problem is you're making a ton of assumptions, right? When I'm showing you this chart, I'm not implying, all right, here's what happens. We go down about 9.5%. It takes about 4 weeks and then we rally. Like, I don't think that's a reason to buy today, right? I think that's just making one comparison. So a much more thoughtful way of doing this, more systematic way of doing it would be looking at average pullbacks. All right, here's the average decline after a big bull market. The problem there is what if this is different, right? What if this is an unusual circumstance, right? What about pullbacks after a multi-year bull phase, after the market trend models have been so bullish for so long, after we've had concentrated leadership where the Fed is in the middle of a rate cut cycle that's been paused, inflation concerns increase. It's like all of a sudden, the more criteria, the more variables you introduce, the less number of observations you have, and the further back you have to go. And so I find it's tough. So I mean, you're looking at averages. We can say what's the average bear market decline and how long does it take, and what does that mean? Note to self to invite someone on the podcast who does that kind of work, because it's not my area of focus. I tend to focus just on the price action. I think that first toolkit of just looking for signs of accumulation has served me very well. But looking at some averages to see what sort of expectations are reasonable, I think that's a fair way to think of it. I will be thinking of some guests. And if any of you have ideas of who you've heard have that kind of a discussion that you think we should have on the show, I'd be very interested, and I'd be happy to approach them. That'll do it for today. I did get some great questions here I did not have a chance to answer. I will put them all in the chart this mailbag, and I appreciate you joining me as we navigate these markets every trading day. Thanks so much again for watching our podcast episodes. You can find that all on our YouTube channel called Market Misbehavior. I wish you all a great night. For Market Misbehavior, I'm Dave Keller. Remember, it's always a good time to own good charts. Have a good night, folks.